Generally, a bond in India, there are various kind of bonds issued, and generally the streams of income which come out of a bond are typically what has been depicted here. Generally, there is a coupon on the bond. There are bonds which are zero coupon, and to the extent that there's an ongoing coupon, it is generally an interest income which gets generated on that bond. There are instruments in the market which are more structured, where there's a back-ended redemption premium which is payable only on redemption. So it's to that extent a structured instrument. Sometimes this redemption premium could be linked to various events. So that is the flow which will come at the end of the bond. And obviously, in the interim, investors could transact in these bonds, and to that extent, there could be a capital gains which would occur on this particular bond. So these are the three streams of income which typically arise on a bond. So just in terms of tax treatment, so government just again on the bond side, the government has taken a lot of measures with an intent to deepen the corporate bond market in India. And one of the things they've come up with is that the bonds need to be marketable, and there has to be sufficient depth in the market where one can trade in these bonds. And that's where this is the tax treatment which the slide depicts. If one talks about listed entities, there is a period of 12 months prescribed. If someone holds it more than 12 months, it is treated as long term in nature. And there are concessional tax rates for listed NCD, which is 10%, which is the second row on this particular slide. If it is short term, then it is ordinary tax rate. There's no concessional rates available on bonds, even though they are listed. So there's a slight difference vis-a-vis equity shares or equity-oriented funds or InvITs or REITs, where there are because STT is payable, there's a concessional rate even for short term. However, for bonds, there is no concessional rate. It is ordinary rates if it ends up being short term. This is what this slide depicts is the present tax treatment. We'll touch upon the budget proposals in the subsequent slides. Similarly, unlisted NCDs, the only difference is that the 10% beneficial rate which is available, that is not available for unlisted NCD. The rate there is 20% on a long-term capital gains tax basis, and the period of holding for qualifying as long-term is 36 months. So this is the current tax treatment as we stand today. One more aspect is that in listed bonds, there is no withholding tax which the issuer deducts. So it is up to the investor to discharge the necessary taxes. And one of the reason for this kind of a construct was that in listed bonds where you could have a situation where there are secondary transactions. Generally, the withholding tax occurs on the record date, and because the buyer, if he buys it on a secondary basis, and say I mean he buys it say two days before the maturity, and on maturity he gets paid the coupon which is applicable or the redemption premium as the case may be. If a withholding tax would have applied, it would have not been cash flow wise okay, because he would end up on the small spread that he would have. There'll be a lot of withholding tax done. So that was the whole rationale why this withholding tax was not there on listed bonds, so
When you
that
say
there could be a
withholding tax means
healthy
TDS, right? If I'm
market.
not wrong, Samit.
TDS, correct. TDS by the company was not there on listed bond, just to create a healthy secondary market, which was the overall intent of the government.
Is there any change in terms of what is the taxation for a corporate versus individual in listed securities, in listed NCDs?
So today, and I'm assuming the corporate is undertaking investments out of its investment book. So as long as the investors hold it as a capital asset, and the listed NCDs would typically yield interest income or redemption premium. which will be taxed at the ordinary rates. Corporates, the tax rates are varying. It could be anywhere from 22 to 30% plus the surcharge and cess. Versus for individual, the slab rates is different. It is 30% plus the applicable surcharge and cess. So that is for the interest. But for the long-term capital gains on listed bonds, 10% is available across. There is obviously surcharge cess differences, which are not that different. Not substantially different for corporates and individuals. It will be a very small basis points difference. So for both corporates and individuals, the 10% rate is intact, basic tax rate, but the basic ordinary tax rate on interest can be different.
Understood. So, what we are saying is sale of listed securities, if it is more than, if it is less than 12 months, then you come under the short-term category. So that is the reason as an individual, you will be charged 30% tax. And if it is more than 12 months, then at this juncture on long-term basis, because it's more than 12 months, the capital gain will be taxed at 10%.
Basically, on the redemption premium, so there are many of these bonds, and we'll come to the specific bond where there's a specific proposal under the budget. But in many of the bonds, there is this kind of concept called redemption premium, which effectively is payable at the time of redemption. Now, there effectively in most of the cases, the redemption premium is a substitution for the ongoing interest. So wherever there is a redemption premium, generally the coupon will be slightly discounted, and to that extent, redemption premium compensates or it's a compensatory for or more akin to an interest income. Any redemption premium is also treated similar to interest income, and on that the normal ordinary tax rates we discussed are applicable. Now the only thing is that the redemption premium generally accrues on the record date at the time of redemption, and to the extent again, if anyone sells it prior to maturity, there is a construct where gains could be capital gains, because that is not effectively coming from the issuer. It is coming as a way of a secondary transaction. So that's where that will be treated as capital gain. Versus if the money is being paid by the issuer, generally the issuer will treat it as interest. If there's a withholding tax applicable, assuming it's unlisted, then they will do a withholding tax. And if it's listed, it obviously is goes back without withholding tax today, and the recipient has to categorize it as interest income. This is a proposal under the finance bill, not yet notified, or the presidential asset is still to be received, and it has to still go through the session of the parliament. So whatever is here is as per the current proposal. It's not a final law. We'll have to wait for another month for the bill to go through the entire process. Also, the way the government has in the past gone about some of these budget proposals, they've actually, after announcing the proposals, they have taken industry, they've done industry interactions and taken their views or observations, and thereafter tried to, if required, incorporate that and revise the bill to that extent. So with that window of any potential changes, I'll just deal with if assuming the bill is enacted in its present form, what would happen. And here we are talking about a specific kind of NCD. This is what we called as a market linked debenture, which has gained a lot of popularity in the recent few years. Generally, I mean, before getting into the tax proposal, I'll just spend some time elaborating on the characteristics, typical characteristics which these market linked debentures have. Generally, they are issued for a 12 to 36 month period. 12 is the minimum period which any NCD has to be issued for. They are principally protected. However, there is no or very limited ongoing coupon, which gets paid on these debentures. And there is a redemption premium, which is somewhere market linked. And I'll come to explain what exactly is the market linkage we see in most of these kind of debentures. So in a way, the bond is held by the investor. The coupon will be limited, or in some cases very nominal or zero. And and post at the end of the 12 month or 24 months or 36 months, as the case may be, there will be a redemption premium. The market linkage is generally to a indice underlying security or an underlying index. If Nifty is at a particular level today, at the time of redemption, which is 25% fall, is where there will be no redemption premium, but otherwise there will be a redemption premium payable. Similarly, I mean, there could be a linkage to the GSEX, where if the maturity value of the GSEX at the time of redemption falls to 25% of the current valuation, then again no redemption premium will be payable. So effectively, in most of the cases, the probability of no redemption premium being payable is generally very low. As in most cases, the scenario is generally happens with that the redemption premium gets payable because the contingency or the low probability event does not materialize. Now, the reason for this kind of a construct is that to the extent that the redemption premium is contingent, from a tax perspective, one cannot say that the redemption premium is crystallized on an ongoing basis, and because of that, till the end, the redemption premium happened or the event happens where the crystallization of this premium happens, there cannot be any ongoing taxation. So that is the reason these MLDs are structured the way they are, where there's a bit of a contingency until the redemption. One cannot crystallize it for ongoing accrual. There is a market because these are listed instruments. There's a market, secondary market for it, and if for example individuals transact in these securities after holding it for 12 months, there is a potential that such an income will be long-term capital gains, which is today taxed at 10% plus charge and cess. So this is what like the MLD construct is. Now, what the budget seeks to do, it seeks to plug this particular thing and treat it irrespective of the holding period of the MLDs or debentures. They propose to treat any income arising on the transfer of these debentures or on account of redemption or maturity as a short-term capital gain tax. So this is a big change which the budget proposes, and short-term capital gains tax would be the ordinary tax rates which are applicable to that particular investor. The effective date. So there's a lot of confusion in the market today
That
in
is
terms
correct.
of when this is effective, whether the current bonds which are issued prior to the budget or prior to the budget being effective from April 1, uh, uh, would they be grandfathered and they'll be continued under the old regime, and only the new bonds will be taxable. So just like the way the current proposal stands, it is effective from financial year 23-24, which means that April 1, 23, any transaction in these MLDs would get subject to this short-term capital gain tax treatment. So effectively, there is currently no grandfathering proposed for bonds which are issued prior to April 1, 23. And obviously, there's a short window available that from today till the 31st March 23, that would obviously continue to be covered by the current provisions. And to the extent that they're already long term, which would mean that they've been issued in the last year, which is 21-22 financial year, except for those bonds which can be sold prior to 31st March 23, any bonds issued during the current year would lose the long-term capital gains tax treatment if they were to be sold through a secondary transaction. When we say grandfathering, we mean that any transactions done prior to the proposal coming effective based on the understanding of the old law, because as an investor, whoever has invested today, he's invested on the basis of a particular tax treatment. uh, Initially, I mean, the proposals, the tax proposals, the way used to come out, the government used to have these retrospective taxation amendments coming in. But in the last few years, we have seen government has stopped doing retrospective amendments. All amendments are generally prospective. So to that extent, this amendment is also prospective. It applies only from April 1, 2023. Now, the only issue, however, here is that because bonds could have been issued prior to April 1, 23, but the transfer would happen post April 23. Would those be grandfathered? And when we say grandfathered, would it be continue to be covered under the tax regime based
Full
on which
tax
the
regime, you mean?
investor, yeah, based on the current tax regime of long-term capital gains. On the bonds, whatever is the redemption premium, the issuer will now have to withhold tax. The base interest that applies is 10,000. So below 10,000, if it's payable, there's no 10,000 rupees. There's no withholding tax. There's an exemption provided. But above that, there will be sorry, for bond it is 5,000. So beyond 5,000 of interest, there will be a tax withholding which the issuer has to be done at the rate of 10%. If the individual is falling below the basic exemption limit, then obviously you can submit the form 15G or 15H. 15H is for senior citizens and 15G is for individuals. They can submit that form, and the company will then not withhold tax or withhold tax at the lower applicable rate.
So
So I
this
think this is,
calculation of
yeah.
15G and 15H, Samip, where do we have to do this? Do we have to do it with the issuer? Is there a procedure that is already come out, or it is going to come up?
So generally, so currently there's already a process for interest which is there, which one can submit. So for example, for banks, if there's a fixed deposit, there's a withholding tax which applies beyond a particular threshold. So similar process is there today for and including, for example, dividend on shares which are listed. So similar process would get extended for the bond debentures.
Okay, so what we are trying to say is that the same benefit that you have in the FD of claiming through form 15G and 15H, that can be done going forward for bonds as well.
Correct.